And the question would be like, why is that happening? What's happening there? Is it that we're not making enough money? Could be margins are being shrunk, right? We have and we have inflation, we have higher costs, we have insurance companies that are compressing margins, and we have really on the back end is the big question is, how much do I need to quote retire? That keeps people on that hamster wheel. So we're going to dig into some of these questions tonight, but that's really the title of the talk. Before I put my slide deck up with some slides, I happened to grab today, and this actually is this afternoon. I still work off of analog to some degree. Just love getting a Wall Street Journal thrown out in front of my house every day. Didn't pick this up till this afternoon because I was busy today. I was on the move a little bit, but I picked up this afternoon and just flipped to the front page. And on the front page, not the top article, but on the bottom half of the front page, this is very applicable to what we're talking about tonight. And the article is America's inflation fight widens a split economy. Split economy. So I'm not going to read the whole article to you. You can pull it down off of the internet. But I'm going to a few key pieces because this really speaks to what I'm talking about. It starts out by saying that this is the third year of America's inflation fight, and it's widening a split at the heart of the economy. Warning signals are flashing for more low and middle income Americans. These are our wage earners, but this is really the core of our consumption base. And as you all probably know, that our GDP, our gross domestic product, is driven 70% by consumption, by what we as Americans consume. It's not by exports. It's 70% by consumption. So if consumption goes down, what does that do to our GDP, to our economy? It goes down. It stagnates. And you could say, well, there's enough people that are making money, and I assume that everyone here tonight with me makes a good living, and that's wonderful. That's a blessing, right? But at some point, you want to take some time off, and you want to get your other assets, your capital base, outside of your practice, your business, working for you. And that's where the conundrum comes from, because I find a lot of doctors have done very well in their lives. They had a great lifestyle, provided for their families, security, all the things that you would want to have from someone who works really hard, has gone to school the number of years you've gone to school, the risk you take every day, and the headaches you deal with. You deserve to have a good lifestyle. The problem is once you want to turn off the tap to that active income, and someday you're going to want to do that, or at least slow down, is how do you take your capital, retirement accounts, tax brokerage accounts, even the capital after tax and closing costs from the sale of your practice, however you decide to do that. How do you take that capital and make it work for you? Not just pile it up, not just stack it up, but how do you make it work for you? That's a big problem today because we're in a market cycle we're going to talk about. A few more pieces out of this article from Wall Street Journal. They say that so the lower middle and lower income people, wage earners, are being whittled down by elevated inflation. So the inflation hurts them the most. If you don't have a way to make more money to rise above inflation, you're going to get hurt. And Americans are strapped today, really, really strapped. High borrowing costs for them. And then those who have assets, your business is an asset, you have retirement accounts, you have money on Wall Street, you have real estate. Well, those assets have benefited mightily, as you probably know, in the last, not just the last few years, certainly the last few years, but like going back to coming out of the great financial crisis in 2008. We've had a bull market run in all assets longer than usual. Normally they run 6 to 8 years. Really 2019, we were running out of gas. That was right before COVID, if you remember. And the Federal Reserve was trying to kick things up a little bit because we were really starting to, I think, turn into a bit of a recession or correction back in 2019. Well, that's 5 years ago. Well, what happened since then? Well, we had COVID, we had a pandemic. And if you keep pace with what the Federal Reserve does, they're printing money or expanding credit. They went to town, did they not? $8 trillion added to the Federal Reserve's balance sheet. That was $8 trillion that they pushed out into the economy, into people's hands. Well, it saved the day, but it was very inefficient. And of course, the other side of that was inflation like we've never seen before in 40 years, going back to when I was a kid in the 70s and really up to the early 80s. We had big time inflation, and that really dissipated over the years because interest rates went high and then it came down over 40 years. The lowering of interest rates over 40 years gave us, who were involved in any kind of asset classes, the tailwinds to allow for a lot of wealth production. It was an anomaly, a great anomaly if you lived during that time, but that time is over. It's not like game over for America. I'm not saying that at all, but the model is changing. The model has changed, And if we're not dynamic enough and be able to pivot, understand what the models are changing, we can get left behind. And I don't think anybody is working hard to be left behind. So last couple of things in this article, they say that investors are now growing more hopeful that the Federal Reserve can tame inflation without wreaking widespread havoc. Well, that's the whole game here, right? Can the Federal Reserve create this soft landing after all the chaos and the volatility and the high inflation, high interest rates? Well, everybody says, well, the economy's great. At least the government says the economy's great. We got the stock market that's, at all-time highs. Wonderful, wonderful for the people who have money in the stock market. They say the labor force is really, really strong. But when you look quarter after quarter, month after month, they're always revising their numbers, are they not? They revise their numbers. They put out numbers to placate the media, and then a month later, like, they're revising the numbers. The downside is, and I think most of you are here because you know this, our economy is, as much as people want to point and say it's all wonderful, it's built on a house of cards. It's a house of cards. And the only thing that's keeping it afloat, in my opinion, is that we have an election coming up in a few months. And they're pushing everything down the line as far as they can. The banks are doing a lot of extend and pretend loans, meaning keeping as much as they can the commercial real estate sector up. That's where we're seeing the first signs, in my opinion, of where the real economy is going. The equity markets, they're next. I think they're going to do everything they can to keep those pumped up because, again, it would be bad news for the current administration if the stock market hits the skids. Even though it only affects about the top 20% of the population, it's still the sentiment of the media, and people are driven by sentiment, the feeling, right? The feeling. Even though we've got middle and lower class that are struggling, they still buy into sentiment. And if everybody says the economy is good, well, they buy into it even though they're struggling. The problem with even if you're doing well or I'm doing well is that the rest of the economy, built primarily on middle class, the great bulk of it, if they're not doing well, then that's going to affect everything that we're doing. Our businesses, your practices, whatever we invest in. If we don't have an economy that is at least growing nominally versus retracting, everything that we built also is subject to massive change. And that's the conundrum. How do you exit at a time when the market's volatile? I know a lot of docs who tried to exit, or actually did exit back right around 2006, 7, 8. Well, what happened? Well, their assets in the markets, the stock market, plunged by over 50%. It came back, but what do you do when you take a big plunge like that and you're no longer earning active income? Now, you may not be in that position. You may be, a number of years out before you are going to be turning off the spigot. And that gives you more time. But more time means you've got to be, I think, today, more prudent about gaining the skill sets to drive your capital, even though you've got your practice, which is your biggest engine. That's the one that's going to keep you afloat. But you've got to learn today. Don't wait until you're ready to exit to try to figure out, well, what do I do now? I talk to a lot of docs every week, and many are in that position where they've got some capital, some assets, but they're uncertain as all get out as to where to put it. And I don't blame them. If you haven't developed skill sets outside of just giving your money to a money manager or putting it in the stock market or 401k, the traditional plan, then you're going to be potentially left out and probably left for a nasty surprise. So let's jump in and let me share my screen. And I'm going to, again, as I said, I'm going to be pretty expedient tonight about getting through this. And I gave you a little bit of a forerunner of what we are talking about tonight. Let me get rid of some stuff on my screen here. There we go. Let's see. All right. I'm not sure if I shared the right screen. What happened? All right. Something's not where I want it. Let's try it again. One more time. See if that does it. Okay. I think we're sharing now. For some reason, it's just
Hey, David, Alex here. Yeah, if you go click on that slide.
Now we got it. Okay.
That should do it.
All right. Perfect. All right. All right. So let's jump into it. All right. Real quickly, who am I? A little bit of background. I did practice clinical dentistry, private practice for just right over 20 years. But I started in real estate when I was actually my first year in dental school, just because of my curiosity. That's why real estate became the backbone of what I call today a plan B. I didn't know where it was going to take me, but I had a curiosity. Real estate made sense to me. It makes a lot of sense to me today because I know what it can do for you. But you have to do it the right way. It's not as easy as clicking a mouse or putting your money in a stockbroker's account. Nothing wrong with that, by the way, but I think today, more than ever, everybody needs diversification across a lot of asset classes, because hedging your bets against what's coming next, and nobody has a crystal ball, but all I know is it's going to be more volatile. We're not going to have these long stretches of bull markets. I think it's going to be a lot more up and down, and so navigating that is going to be a different story. My daughter faced a lot of illnesses in her early years, leukemia, a liver transplant, and that's what motivated me. Well, didn't motivate me. It actually gave me the reason why to leave my practice when I did. I could have still been practicing. I could still essentially practice today, but I left, and what let me leave financially was the fact that I had enough. Coming back to that question, is how much is enough? Enough real estate providing the passive income to leave dentistry for a period of time. Well, as it turns out, I left permanently, not because I didn't like dentistry. It's just I found a new passion in life, and my real estate gave me the bedrock to do that. And what I'm saying to you, you don't have to leave dentistry today and make real estate your next thing. I'm not saying any of you should necessarily do that, but if you have assets that can give you more stability, and particularly in light of the economy we have today and inflation rearing its ugly head, which I don't believe is going to go away. I think it's going to be with us here going forward. You've got to have assets that you understand and can at least keep pace with inflation, if not try to exceed it. Since leaving practice now over 20 years ago, Freedom Founders just grew organically to where we are today, and it's really a blessing and a privilege, and I feel like even an obligation to try to share. Not that I know everything, not that my way is the only way, but what I know how to do is help others at least gain the mindset and the perspective as couples to take their desires and their dreams, reverse engineer it back into where they are today, and now they've got a plan going forward. It's that clarity of a game plan that I think I'm really good at. Again, there's multiple ways to get to where people want to go, but most people never have those conversations and dial it back in to figure out how to do it. The big thing for me was I got time. I wanted time. And I think everybody today, wherever you are in your life, you want time. Time's the most precious thing that you have, but it's something that you can't buy back later. You can buy more time today, but you can't buy it back after it's gone. And I think that's the key thing to keep in mind. All right. So what concerns you most about your retirement plan? We did send out, and a number of you did respond. I'm going to just give you the top responses that came back. Not having enough capital to retire or to stop practicing. That was about a third. Said that was their concern. Second one was lack of trust in the stock market to create predictable returns. Again, right close to about a third. And then the third one was economic, political uncertainty. Again, about a third. So about a third had those particular concerns. So I thought that was interesting, and I think that weighs into how I see it. And with the doctors I talked to today, those are very similar concerns. So we talk about the accumulation versus the replacement income model. Accumulation is what I call the traditional 401k tax deferred plan. Everybody does that because everybody says that's where you need to go, because you can defer taxes, you can get your tax deduction today. It's all wonderful, and you can compound tax deferred. Okay, great. Nothing wrong with doing some of that. But I think if you put everything there whole hog and don't learn how to invest in alternatives as you're going along, then you're making a mistake. I'm all about replacement income, about income, not accumulation. Now you got to accumulate to a certain extent, but what I see is many docs don't know how much they need to accumulate, so they just keep on the treadmill when you actually understand how to reverse engineer and say, how much do I need to accumulate to drive a certain amount of income, replacement income? Now that changes the math altogether. And because of milestones that you can actually measure, that's what I don't find any financial advisors do. They don't do it that way. It's all about accumulate and then divest the traditional 4% per year and hope that you don't hit a market crash about the time you leave active income, which is the scary part, when you're depending upon so much capital to deplete. I don't deplete. My principal stays, my principal grows, and it's like having the golden goose that produces the eggs. I'm not going to kill the golden goose, but that's the plan I work off of. It's not the plan the traditional model works off of. So the uncertainty of how much is enough versus specificity of a freedom number, a number. We'll talk briefly about the freedom number. Depletion of your principal, taking that number down, which is unsustainable. It's going to run out at some point, versus sustainability, no depletion of principal. You're more vulnerable, in my opinion, this is my opinion, to market volatility. The stock market, when it's on a tear up, it's wonderful, but it's driven so much by euphoria and psychology. I love the alternative space because to me, it's more real based on fundamentals. Yes, there's some euphoria there, but not nearly to the same extent because it's an inefficient marketplace. So it's slower to react and respond than the stock market. I just don't like all the volatility. That's just me. Just more consistent, predictable income despite market cycles on alternatives. Risks of chasing yield. Everybody wants to chase yield. How much return am I getting? Bragging rights. I think it's the wrong way to go today. In fact, it's very dangerous to do today, in my opinion, because of where we are in the market cycle. After we've gone through a market correction, maybe we're down in the trough somewhere. Okay, you can play a little bit more seeking yield, but right now is a dangerous time to seek yield. Versus manage risk and taking what the market gives you. So we talk about in Freedom Founders much. What's the market giving us today? Where can we place capital? And number one, preserve capital and get a market clearing return, not chasing some yield. The disadvantages to those tax-deferred 401k type plans, well, higher future taxation. When you take those distributions out down the road, where your taxes are going to be, I can guarantee you they'll be higher. I can guarantee it. They'll be higher than they are today. The money's locked up till 59 and a half. You're locked up. You can't take it out without penalty. You can self-direct it, which is a big thing we do in Freedom Founders, self-direct into alternatives. If you understand how to do that, you can divest, not divest, but actually recirculate or divert some of the capital in your retirement accounts to alternatives. You don't take it out to do that. You leave it inside that box, which is where you want to leave it, which it's there, but you can diversify. So that's a benefit to those who have the lockbox. It also provides, in my opinion, an ignorance by abdication, meaning everybody thinks just put the money there. Well, that's a good discipline to put money somewhere. But when you do it that way, you're not really gaining a skill set on how to invest money. That's my opinion. As I said, higher tax brackets, you're converting potentially in equities, long-term capital gains to ordinary income. That's when you take it out. High income, you also lose in your retirement accounts, you lose the stepped up basis. That's wealth transfer. Your kids, your beneficiaries, your heirs, they're going to pay tax on those gains as beneficiaries of your retirement accounts. Outside of your retirement accounts, they get a stepped up basis. If they sold those assets the day you pass, zero tax. They get a stepped up basis. So you lose a lot of benefit in those retirement accounts that everybody plaudits as being, the no-brainer. I just mentioned stepped up basis. And then you also lose in equities, you lose the benefits of depreciation, cost segregation. Already said the long-term capital gain treatment all gets wiped away. And we can also do exchanges in alternatives to maintain our basis without paying tax. We can exchange to other assets. You can't do that inside your retirement plan. So you're very limited there is the problem, but everybody does it because it's the easy button. I'm just saying, don't put all your eggs in that one basket. And I think that's why you're here, to learn about what else can you be doing. Already said we have the cash flow model versus the accumulation model. The accumulation model, you're just going to be taking that principal down over time, hoping, keeping your fingers crossed that you don't run out of money and principal by the time you pass. With the cash flow model, you're going to maintain and actually even grow that net worth, so you can give it away to charities. You can have something to transfer to the next generations, whatever you want to do, but you don't have to live on a scarcity model of, am I going to run out, especially with inflation in place. So as I said earlier, chasing yield, more ROI is not the answer. ROI is part of the equation, but it's not the big deal. If you chase ROI, as I said earlier, particularly today, you're playing a dangerous game, in my opinion, my experience. Warren Buffett says we at Berkshire Hathaway, we don't depend on everything being hunky-dory all the time, because it's not. It's not. We run our business to be the last man standing. That's where you want to be. Last man standing, which means more principled investment, more conservative investments. Again, taking what the market gives you. There's times when the market's going to give you a lot. And preparing for that, the opportunities on the other side of a market cycle shift is a huge opportunity. But again, are you preparing for that? Do you know where to go? Do you know how to access those opportunities? It's what I call the great wealth transfer. And I hit some big ones coming out of 2008 because, again, I'm positioned. I know where to go. I've been there before. If you want to do the same thing, you've got to position yourself and have the education and the connections to make those big hits. Don't want to miss out. These generational wealth transfers come around only so many times during a lifetime. And if you can hit at least one of those, it's going to be a game changer for you. So here is the market cycle. You have, peak to peak or trough to trough, but most people don't understand that what goes up is going to come down. It's called reversion to the mean. This is a normal market cycle. Where are we right now? Well, I think it depends on asset classes. I think we're still in the equity markets with tech stocks. We're still in euphoria. I mean, euphoria is there big time. Very dangerous place to be, by the way. I'm not giving you financial advice, but if you've made some big wins there, figure out how to take some chips off the table. Talk to your advisor. Where could you move to higher ground? Don't leave it all sitting there, is what I would say. But good for you if you made some money there. You rode the market, right? As the market's correcting right now, Where do you go to higher ground? Where do you position? Do you go all to cash or to treasuries or to money markets? Well, you don't want to go all there because, again, you get a decent nominal return, but that nominal return of 5.25%, that's still a negative return based on inflation. And by the way, inflation's not running at 3.5%. I think you all know that. It's more like 8, 9, 10, 11, 12%. So if you're getting 5.25%, which is safe today in treasuries, you're still behind the 8 ball. So you can't put it all there. So understanding asset allocation and how to maneuver through these markets is a skill set. Again, you can learn to do this. Reinhardt and Rogoff wrote this book back in, I think, 2011. It's a great book. This time it's different. Basically, I'm going to read the highlights in this book, but they say excessive debt accumulation, whether by the government, which the government's doing it big time today, banks, corporations, or consumers, individuals, often poses greater systemic risk than it seems during a boom. That is exactly where we are. The house of cards built on debt, across the board debt. This is not something that is sustainable. Such large-scale debt buildups pose risks because they make an economy vulnerable to crises of confidence, particularly when debt is short-term and needs to be constantly refinanced. Exactly where our government is today. They're having to refinance, turn the debt that this country is amassing by what, $1 trillion every 90 days on short-term, short maturity bonds. That cannot last, ladies and gentlemen. They're going to run out of gas. They can't continue to do this. They're at the end of the plank with an analogy there. Highly leveraged economies, it's what we have today, can seem to be merrily rolling along for an extended period when bang, confidence collapses, lenders disappear, and crisis hits. We've got essentially 3 bubbles today. We've got the equity markets, stocks, tech stocks particularly, right? We have the real estate market, which is starting to deflate on the commercial side, and we have the credit bubble. This is the first time we've had like a triumvirate. In the past corrections, we've had one here, one here. We've had different bubbles. We've got 3 right now. Any one of those can start driving the other ones, and when they pop, if they all pop fairly close together, it's going to be a heavy, heavy downturn. You've got to know how to position yourself, not just your investments, but your business too, your personal life. Be doing it now before things hit the skids. And I think things will hit the skids, if not before the election, probably shortly thereafter. That's when they're going to quit kicking the can down the road. The harsh reality is going to hit, and it's going to hit home hard. They said 8 centuries of experience suggest this time is not different. Pick up that book if you want to. It's an interesting read. The 70s. I mentioned the 70s a few minutes ago. I was a teenager kid going through the 70s, so economically I didn't factor into me because I wasn't a big consumer. I wasn't on my own by any means. I was still in school. But in reflecting during those times, I think that's what we're rolling back into. Stagflation means you have an anemic economy where there is little or no growth, but you have the inflation, the costs going up. That's probably the most dangerous economy for everybody. It's very, very dangerous times. And I think that's exactly where we're rolling. There's a lot of triangulation that's pointing to that. And again, if it's something you're interested in, there's a lot of material you can read about what we call the lost decade of the 70s, where the stock market just basically flatlined. In fact, flatlined, and with the inflation actually went down. That was over like 15 years, from 65 to about 82, 15, 17 years of no growth and actually decline in one's principal. Unless you had a business that was keeping you afloat. But this is, for savers and retirees, very difficult time back then. You don't want to be in that position, but I think that's what we're headed, and probably for more than a few years. I think this is a problem because, again, why? We just crossed the mark to $35 trillion in sovereign debt. And that excludes all of the additional unfunded liabilities like Social Security and Medicare, which we're just piling on like crazy. This is a house of cards. Well, there it is. There's the national debt. This picture was taken just probably a few days ago. We've crossed 35 trillion. So it said we're adding $1 trillion every 90 days. That's some serious, serious money. Can't even imagine how many zeros makes up $1 trillion. It's immense. Inflation. So we haven't had inflation until the last 2 years, right? When by the government figures, 9.1%. Now they say we're down to what, 3.5%, or their target's 2%. But again, they manipulate the numbers. You all know what your costs are. Your costs are way more than 3.5%. Whether it's in your business, your practice, your home, utilities, food, insurance, property taxes. I mean, just across the board, we're way over that. So they manipulate the numbers because they want to keep the sentiment, make everybody feel like they're winning the war against inflation, which they're not winning the war against inflation. They're stoking the flames, and they'll continue to stoke the flames. You've got to keep inflation in mind. You can see at 5%, you take $1 million at 5% in over 20 years, you've lost 65% of your principal purchasing power in 20 years. I'll show you another one. At 12%, which is really where I think we're somewhere between 9, 11, 12%. I can guarantee you. So look at that. If you take a look at 12%, in 6 years, you've dropped by half. So 12%, you drop by half in 6 years. That's the rule of 72, by the way. You can do the math in your head if you know the rule of 72. In 12 years, you've dropped all the way down by 75%. That's a serious decline in purchasing power. How are you going to keep up with inflation when you've left your active income? Because that's what's keeping you afloat right now. That's what lets you try to build for the future. You've got to be able to understand how to make your money work for you efficiently without taking major risk. So my investment philosophy is this. Day traders, which I am not one, they watch hours and days. Speculators, which I'm also not one. Well, if you put your money in crypto, I'd say that's some speculation, and that's okay to say a certain amount of money if you want to speculate. But they watch weeks and months. Investors, which is where I am, you watch years and decades. Playing the long game. That's Warren Buffett. You play the long game. And I think that's where you need to put your head. Don't try to play the short-term gains and ride the crest of these euphoria, because I think it's a dangerous game to play. The risk curve. Actually, I'm going to give you something. If you stay with me a little bit longer, I'll show you how to get it. And so I'm not going to explain this to a great deal, but the risk curve is something we use in Freedom Founders where I can show our members between equity and debt. Now, when I talk about debt, I'm not talking about debt that you borrow. I'm talking about debt that you own, like a bank. So there's two places to basically play. Same thing in the markets. You can buy stocks, which is ownership, that's equity. You can buy bonds, which is debt, right? So you typically know that bonds are typically safer than equity, right? I mean, it's just kind of standard. Well, you can do the same thing in real estate and alternatives. You can own the equity, which is the sexy part, right? That everybody always wants when the market's going up. But when the market's not going up and we're actually declining and looking at probably stagflation, then why do I want to take that kind of risk out on the risk curve? I want to stay more on the debt side. And that's what we teach our members how to do. How do you allocate to debt? And then at the right time, move your money back to equities. You've got to kind of balance things out as you're going through, as a good advisor would do in the financial markets, stocks and bonds, right? I'm not going to say it's easy. It's easier to do in alternatives if you have the access to the education. Harder to do if you don't. But I'll give you more information on that. So which is more important for you? Net worth, the accumulation model, or cash flow? Well, for me, it's cash flow. I like net worth. I like equity, but I want that equity to produce something because that's where I can measure its true value to me. All right, the freedom number is something that came out of my own life story when I was figuring out on the back of a napkin when my daughter was in the hospital recovering from her liver transplant, and I'm trying to figure out, can I prudently, my logical brain, my left brain, can I prudently sell my practice and take a year and a half off? Do I have enough capital invested in assets, real estate, that would produce the income that will still provide for my family? Back of the napkin calculation, it's not difficult. And that's where freedom number came from. This is what we teach our members is to what number do you need to replace a certain amount of income? All of your lifestyle income, part of it, where do you want to be? We have milestone stages, and this way you can measure it and see where you are, and it gives you, points of reference as to measuring exactly how much income you're replacing. So when you do want to take time off or sell your practice, you know where you are, you know you can do it. That's the whole key to the freedom number. All right, this book that you're seeing on the screen, just published it. We're going to give you a copy if you take a picture here. But how much is enough book.com. Again, this book is a book that my team and I published based on the fundamentals and the principles that we teach in Freedom Founders about not accumulation, but how much net worth do you need? How much is enough to produce the income that you need on an inflation index basis? Once you know that number, then you've got targets. Then you know how much you have to do, how much you have to net on your practice sale, how much you need to make your retirement account work. Whatever you're doing, you've got a number instead of just pile it up, and never have a clue. That's the key to exit. That was the key to my exit, understanding how much is enough to make my exit, and the rest is history. It's just math and understanding the right assets will produce the results you want. So if you'd like a copy of this book, go to howmuchisenoughbook.com and we'll send one to you free, no strings attached. So we reverse engineer to freedom. How much is needed to achieve, say, $150,000 annual income before tax? Just taking a hypothetical. You can put whatever number you want to on it. At 1% return? Well, the math's pretty easy. I got to have $15 million of capital at 1%. Hopefully I can do better than 1% today. Well, actually you can. You could do 5% risk-free, right? But 2%, I need half of that amount. At 4%, I need 25% of that. At 8%, I need 1.875. And at 10%, I need 1.5 million. It's basic math. You can see what I'm talking about. When you can predict a safe return, then your capital needs, that accumulation number, can actually come down. As we tell people in our tribe, you're closer than you think to be able to make your exit based on your ability to deploy your capital in sustainable, predictable income assets. It's a skill set. It's based on network and connection. That's what it is, education. This was my first generator of replacement income. You know, it's a house that I bought with my dad back in 1980. Gosh, that's 44 years ago. This is what got me started on real estate. And when I saw the benefits of what real estate would do for me, I never looked back. Yeah, I went on to become a dentist, but at the same time, I was building my real estate portfolio, and thank goodness I did, because I could exit some, well, from that point, some 20 years later, when my daughter was sick and I needed more time. This is what alternatives will do for you if you do it the right way. So what are your concerns about real estate? Well, I jotted some down. Let's see if these jive with yours. You don't know how. That's probably a big one. You don't understand it completely. You don't want to be an active landlord. You don't want a second job. I don't think you need a second job if you're a highly skilled, highly educated professional. You don't know how to evaluate real estate investments. That could be a reason. And you probably also talk to people who've lost money in real estate, which you certainly can. Those would be, and maybe one more. It's illiquid. Okay, how about that one? So there's a bunch of reasons why real estate. You might say real estate. I don't want to do real estate, but there's good answers, as there would be to most things that are solid in history. Anybody who has built up wealth has had at least some of their portfolio in real estate. You know that for a fact. So real estate can't be bad. It can't be risky. Well, it can be risky if you do it the wrong way. So understanding how to do it can make a very stable portion of your retirement portfolio. That's what we do in Freedom Founders. The main problem we help practice professionals solve is helping them buy back that time. That's the key thing, is you're buying back your time by creating assets to produce the income that allow you not to have to necessitate you going to work. You work if you want to. Work becomes work optional. You can confidently replace and rely on and not relying on the active income from your practice. That's a key to freedom. And as I said earlier, real estate is one of the best ways to create passive income that I know of. There's other ways, but to me, real estate has so many benefits to it, so many extra benefits. Most high net worth investors believe that real estate should have a place in their portfolio. But as I said earlier, how do you do it? Problem is, most practitioners are too busy to develop the skills sets to confidently invest in real estate in today's very volatile economy. It is a dangerous time to step out into most anything if you don't have experience or have someone to guide you. It's a dangerous time to try anything new. You got to be careful. Got to be careful because the market's very, very volatile right now. We talked about accidental landlords, or using what we call a family and friends investing strategy. Hey, you know, Uncle Bob, you know, he's investing in XYZ over here, and he thinks it's a killer deal. Well, maybe it is, maybe it isn't. You know, what does Uncle Bob know? Maybe he knows a lot. I don't know. But, you know, family and friends is probably not the best strategy for investing. Just saying. Freedom Founders is like a shortcut. It enables professional practice owners to full-time, that collapse the time, become sophisticated investors. You want to become a sophisticated investor. You want to become one. You can do it. It's not something that's hidden, some mirage that Wall Street makes it too complicated. It is not that complicated. You don't have to have an MBA or high extra degrees. I learned everything I learned about finance and real estate and negotiation and contracts. I learned it by doing it, but I've been doing it for 44 years. What I love to do is collapse that time for other professionals who want to learn this, but not have to go and have the brain damage of 44 years. You don't have the time to do that. You know, buy back your time, invest in yourself is the way we do it in Freedom Founders. So why does this work so well? Just one of our members, Dr. Cody Cowan, he is in his early 40s. He created enough real estate income to make the critical evolutions and elevate his leadership in his practice. He still practices, but by choice, and he's got partnerships, and he does as much or as little, I should say, clinical dentistry as he wants to. He really has created a lifestyle. And why? Because he's got, like I had when I was evaluating my portfolio, when I needed to leave practice because of my daughter, I had enough. when you have that extra income, doesn't have to be replacing all of your income all at once. That's a goal. But you have enough there, it can change your model, change your mindset. So even if you may want to practice for another 5, 10, 15 years, if you're building something on the side, it gives you that extra stability to try. Maybe you try an associate, maybe you buy an extra practice, whatever you want to do, but you got extra stability. It provides you that stability that you don't have if all your eggs are in one basket, and then you're afraid to try some things. Freedom Founders is do it with you versus do it yourself. Now, there's nothing wrong with do it yourself. I mean, that's how I started in real estate. It was all do it yourself. Well, why? Well, I had lots of time when I was young, in my 20s. I had very little money, and like no credit. So my time is what I had to bring to the table, so to speak. But today, I value my time way more than I did when I was younger. And so I don't want to be out there doing it hands-on. I know how to do it hands-on, but people in Freedom Founders don't want to be the landlords. They don't want to do it hands-on. They want the relationships. They want the education. They want the curation of opportunities and to understand how to balance their portfolios between debt and equity, back to the risk curve. Dr. Bob and Gertrude Dubansky, one of hundreds of our members, when they came to Freedom Founders, they were both dentists, both practicing, and Gertrude had a hand injury, so she wasn't capable of doing much more than hygiene checks and just very basic dentistry. Her husband Bob was having to carry the load of their 2-doctor practice, and he was just getting burned out. And the typical situation was financial advisor, not a bad person, but was not giving them any way out. And Bob was just literally getting burned out, and Gertrude was worried about him that he might just keel over in the chair because he's working so hard and stressed out. Came to Freedom Founders, not that we're magical, but again, by creating the blueprint, the construct, and then having a community around them that have already done it or moving that same path, within 9 months, the practice is on the market for sale. They're out now. This was like 3 years ago. They're out, completely out. They moved out of California to Reno, Nevada, where they could escape the high taxes and they spend time with their family. They're loving life. This is the story of how we help Freedom Founders members. This is what works. Now, you've got to be a certain place in your life and caliber, and we'll talk about that, but this is what we can do for the right people. So who is Freedom Founders for? What's the good fit? Coachable attitude. Yeah, you don't want to come in and say, well, I already know everything. That's not a good way to learn something new. Your debt, you don't have to be out of debt, but your debt should be well managed, right? Should be fixed rate, amortizing. You may still have some in your business. You may have some on your commercial real estate. You may still have a home mortgage. As long as it's stable and you're paying it down, that's not a problem. You want to be more passive than active. Again, if you want to learn how to do boots on the ground real estate, there's places out there to go do that. That's just not who we are. So just make that clear. You need to at least have $1 million of deployable capital or equity. I'm not talking about cash. I'm just talking about equity somewhere. Retirement accounts, tax brokerage accounts, whole life insurance, cash on hand, whatever it might be. But to make this work, we need people of that caliber. Doesn't mean if you're short of that you shouldn't be aspiring to learn these principles. But for Freedom Founders, we set some somewhat arbitrary, but for reasons we can tell you later why that number works. And most of our members come in with a fair amount, not a fair amount more, but a little bit more than that. And that's where in those hands, what we do really makes a big difference. Need to understand the value of real estate. In other words, you like the idea of real estate, but you're not sure how to get started. Not a fit for Freedom Founders would be you're still growing or acquiring practice or practices. In other words, if your focus is on growing your estate through your business, that's where you should focus. You should stay there. Don't deviate into something else until you've got some momentum there. If you love being active, if you're a younger person and you're out there and you've been doing some real estate and you're active doing it, you like it, then just keep doing that. Maybe Freedom Founders is good for you later when you're tired of having that second job, so to speak. If you're really pushing for high returns, you want the double-digit IRRs of 3 and 4 years ago, which they were there. Today's not a good time. So if you still think you want to get 18, 20, 22%, that's not going to be here. We're not going to play those games, but you can certainly find people that will tell you that in other places. Just be careful. If you're still growing your capital base. So again, you maybe been prudently paying down debt, so you're not building up additional assets. That's a good thing. So I said building up your practice, but you're not to a point where you have enough capital that would really make a difference in Freedom Founders. Again, the principles will apply and get you there faster, and I've got a place for you to learn principles if you're not ready for Freedom Founders. So if you want us to help you create passive income through a real estate portfolio so that you can stop relying on your practice and start to build that freedom transition, that easy thing to do. And again, we're very easy. We just like to help the right people. Schedule a call with my team. Just schedule a call. They're really easy. It's not a sales call at all. It's more of a discovery call where they'll walk you through some of the elements that we talk about. And if anything, it'll give you a reflection back on where you are and maybe some steps you can take before you might be ready for Freedom Founders. If you will, to begin the journey, part of the next steps for a lot of you would be to join what we call our Catalyst group. This is online. This is like precursor to Freedom Founders. If you'd like to learn the principles I'm talking about, whether you're a candidate for Freedom Founders or not, this Catalyst group is online, meaning it's virtual. I'll give you more specifics about it. I've been doing these online groups for about the last 4 years. They're a lot of fun. They're a lot of fun for me and a lot of fun for the groups. We keep the groups small, so it's highly engaging. So I get to know who you are, get to know about your practice, about where your assets are, what your goals are and your timelines. It's very engaging. It's collaborative. So I'll tell you more about that, but this might be a good place for some of you to think about going because the investment is very nominal and you don't have to travel. So together, during the Catalyst group, which we're going to start one in September, it's how to create wealth in up markets or down markets. And we've certainly had both in the last few years, and we're heading into more of a down market, but then it's going to go back to an up market. How to find the best investments for any stage of the market cycle and what to stay away from. Probably the biggest thing is what to stay away from. The capital stack, I talked about equity versus debt investments. We'll break that down and show you how we do it in real estate to be on the safe side of that risk curve. What are the best opportunities for creating passive cash flow in today's economy? Again, coming back to, the risk curve, debt versus equity. How do we best do that today to maintain capital and not just chase yield? The anatomy of a deal. This is a framework that really came out of my own life, and I'll show you how it works. But it's how you can participate in real estate without having to do the whole thing. And that's certainly where I am today in my life. I don't want to do the whole thing. I mean, I don't want to find the deals and manage them, and I'll fund them, but I don't want to put them together. But how do you do that the right way? Key aspect there. Evaluating the current market cycle, avoiding the bad investment strategies, and then funds and syndications. Most of you have probably heard about funds and syndications. That's not the only place to invest, but it's very important today, particularly as passive investors, to understand the ins and outs of funds and syndications. There's intricacies that will make or break your potential investment as a limited partner, and that's something we're very much on the forefront of. And lastly, but not least, tax benefits. How to maximize the tax reduction strategies that alternatives provide for us, and there are many of those, as you're probably familiar. So how this Catalyst group will work. It's on-demand training, which means I value your time. So what I've created is training modules that will give you the key principles ahead of time. Ahead of what? Well, we do a live call every week. I've gone 90 minutes, 2 hours, as long as people want to stay, where we discuss the principles, which I teach you in the modules, so you can listen to those on your own time because you're busy. You don't want to take a lot more time away from your family. I don't want you to either. So I give you up-to-date modules. You watch those on your time. They're 5, 10, 15 minutes, maybe a total of an hour or so, but you can break those up over a week. And then we discuss them. That's the fun part. We discuss them every week in our live collaborative group. So there's the live weekly calls. We do those on Zoom. And I bring some other people on with me, sometimes people from Freedom Founders, sometimes some people that we invest with, really break down the elements of how to be a sophisticated but more passive investor. And then we've got a private online group, which 24/7 interaction. And I'll answer questions during the week. I'll sometimes do additional training videos. Someone asks a question, and I'll do a video back to explain principles. I enjoy the heck out of this because I love people asking questions. I love to fold time for people and help them avoid the potholes and the minefields that you otherwise would go through with the brain damage that would take if you started over from scratch. Realize that the longer you put off building your portfolio and understanding the diversification that alternatives bring, the harder it's going to be to get to confidently reach your freedom from your practice. You've got to start sooner, not later. Joseph Campbell, Hero's Journey. The very cave you are afraid to enter turns out to be the source of what you're looking for. Bear that in mind. I think there's a lot of wisdom there. Don't be afraid, especially when the risk is very, very low to try something or learn something new. Later, the word later is a word for never in my vocabulary. The important is rarely urgent. The urgent is rarely important. Do not become a slave to the merely urgent. So if you're a practice professional with close to $1 million or more in potentially investable capital, this is your time to finally take the first step towards your freedom. So here's how you book a time with my team. Just go to freedomfounders.com/discover. That's freedomfounders.com/discover. Again, they'll spend 30, 45 minutes, an hour and talk to you. And really it's a benefit if you come together with your spouse. Because again, no one's going to sell you anything. They're going to help you discover where you're at and what goals you're trying to achieve. And I can guarantee you, whether you do Freedom Founders or not, whether it's the right time for you or not, you will gain so much clarity, you and your better half, about where you are and what things you might want to do, wherever it may be. I can promise you it'll be worth your time. And if you book a call by tomorrow night, now, why do I do this? Because many of you are going to sit back and analyze. I know who you are. I do the same thing. You're going to analyze, well, gee, I don't know. As I told you, there's no risk here. All right. No one's gonna sign you up with a credit card. It doesn't happen. But just to help you along to overcome that inertia, that risk curve, I talked about the equity and debt. I've got a whole training around that. Okay. If it's something you like, if you book your call, just book your call, not have a call. Just book your call. You can have it next week in 10 days, whatever. Just book it. We'll send you the training. That's just a little way to get you to move the needle, just to have a call to get the clarity. All right. Fair enough. Easy, no strings attached. You can do that. There's the risk curve. That's what the training will be around. It's very, very good training. Our members love it because it gives them the visualization, the classification of where their different investments fit, including stock market, wherever you are there. I love this quote by Theodore Roosevelt. In any moment of decision, the best thing you can do is the right thing, but the next best thing is the wrong thing. And the worst thing you can do is do nothing. In other words, what he's saying is you got to step forward at some point. You can't sit back and analyze, put your head in the sand, wait for a perfect time in life, because those never arise. What I'm giving you, if you have any interest at all, is an easy way, very low investment, very low risk. In fact, well, let's just take the risk off the table. I tell everybody, if you do the online course, if it has interest for you, and you do it for the first couple of weeks, and you go, you know what? It's not what I wanted. It's too much. It's too little. Whatever you say, I'll just refund your money. I mean, that's just how I work. All right. So there is absolutely no risk at all. So if you're even thinking about this, if you don't do something, I mean, just look at the quote there. All right. And once again, for anybody here on the call tonight, there's the book. You can get it at howmuchisenoughbook.com. And I think, wow, just I looked at my clock. I did it in 50 minutes, Alex. How's that?
It's terrific, David. Well done.
All right, so I'm going to break the screen share. And as I said, I'll stick around and answer questions. So, Alex, you've probably been maybe fielding some. So, what have we got tonight?
Yes, we have just a few questions here in the chat. And for the audience, feel free to post any questions that you might have for David. He's happy to just free flow with some Q&A for a little bit. But the first question we have here, David, is what specific types of real estate does Freedom Founders focus on? Single family, multifamily, commercial?
Little of everything. Now it's going to be geographic and market cycle specific. So I'll just say it real quick. Single family equities, owning single family houses, which is what I grew my portfolio on during the 80s and 90s. Today, right now, because we have this dichotomy of high prices, right? The inflation, the appreciation, particularly coming out of COVID with all the stimulation, and now the high interest rates to try to fight inflation. We've got this dichotomy of high interest rates, high equity prices. Not a good time to be buying what I consider a bread and butter aspect to a good portfolio. So what we do with single family is we lend the money, not to consumers. No, I'm not making loans to consumers, to commercial borrowers, the people who are actually producing the houses or renovating them to either hold as rentals or to sell to the consumer market. Much safer to be on the private credit side than the equity side. So great question. That's what we do there. Commercial wise, yes. I mean, we're looking at the asset classes that make sense, but for the most part, I'd say 75% of our focus today is on the private credit, the debt side. Equities, smaller today. Why? Because where we are on the market cycle. So again, with the right allocations and the right opportunities, you can select the right asset classes, even in real estate, so you're not riding, or what I call trying to catch a falling knife. You don't want to be doing that. So we really have a wide curation of opportunities in Freedom Founders in terms of the assets that you can invest in.
The next question sounds like it's from maybe a veteran doc. He says, "What about those of us who have primarily invested in a 401k as we were advised by various financial planners, CPAs, etc.? Is it possible to invest those funds into real estate, or did we miss out on this opportunity?"
No, it absolutely is. You are allowed by law to self-direct your retirement account funds, be it 401ks, cash balance plan, defined benefit plan. You're allowed to self-direct those accounts. Now, I will tell you that if most of you would have like a 401k, it's going to be an office 401k where you have allowed your employees. I mean, that's why you do it, right? So it's kind of a benefit for your employees. You're not going to be able to allow your employees to self-direct. It becomes a fiduciary problem. So typically what happens is most of our members at Freedom Founders actually end up terminating their 401k plans, which allows all of the account holders, including your employees, to roll over their capital in the 401k to their own individual IRA accounts. You're not taking a distribution, no tax. It's a tax-free move to move. Now, once you have your money in an individual IRA, a traditional IRA, now you, as the owner, can invest in self-directed assets, which could be alternatives. Your employees probably not going to do that, but they could, but you're not going to be the one helping them. They keep their money in their own accounts, and they can go to Schwab or Fidelity or Vanguard or Edward Jones or wherever they want to go. You could still supply for them the same benefit they had been getting in the 401k. You give them the same participation, however you participated, whatever they got. You still can write them that check every year. You still get the deduction, which is what you want, and they can decide what to do with that money. Smart ones will probably put it in an IRA and get their own deduction, or they could go spend it and pay the tax on it. Actually, employees I've found like the option better. They get to choose rather than you dictating. It's not up to you to provide for their future. They have to decide. But back to your main question, yes, you did miss out. You can put your retirement account monies in a position where you can self-direct through licensed self-directed custodians, of which there are many in the country that allow you to invest in alternatives. Your standard account houses like Schwab, Fidelity, Vanguard do not allow for investing in real estate. So you have to go to custodians that specifically allow for that, and there are many that do that. So that's what we help our members do in Freedom Founders. Good question.
Great. Then we have a couple of questions along the same theme here, so I'll just combine this into one question. It seems like real estate, like the stock market, has peaked and now may be facing a downturn. Is now really a good time to be getting into real estate?
In the right part of the risk curve. And again, we'll send you that training if you'd like to book a call. That's the whole key. So you're right. I would not be out on the spectrum of that risk curve, which is out in the equity side, which is the traditional place where we like to go. Leveraged equity, when the market's rolling up, right, and everything's going up, that's where you want to be, because you're going to compound that equity growth. We've crested over that now. We are on a downturn. So where do I want to position now? Down on that risk curve where I can still get 9, 10, 11, 12% on my money. I'm not going to get the tax benefits on that, but that's okay, because I'd rather be safe, have my money in more liquid accounts, which is what private credit is. It's more liquid. It's not going to be in equities like you're going to be stuck for 5, 7, 10 years. And as the market rolls over and comes down, what am I going to do? I'm watching the right operators, which we have, as we're watching the market. When's the right time to move my money from private credit, or some of it, not all at once, back into equities? And as that market goes down, remember, it'll go back up again. Now, I don't know it's going to go back up like it did in the last years, but there's a time to catch that trough and start reallocating money there. So my point is, wherever we are in the market, and that's part of what we talk about in the Catalyst Group, wherever we are in the market, there's a place for you to put your capital and not put it at risk, so you're not riding that market down, which is what most retail people do. They don't know. Everybody went out and bought, rental properties or short-term rentals, right? Where's that market going right now? They over leverage, they're in trouble, right? So that's why we stay away from that stuff. It's only just through experience. It's just through experience and going through these market cycles as many times as I have to know better. And not that I didn't make mistakes. I've made mistakes, but let me be the one to make the mistakes and save you from making mistakes is what I would say. So yeah, good question.
Great answer. Thank you, David. That sums up the questions from the live audience here tonight. But as the audience, if y'all are reflecting on this, or even for those who might be watching the replay, feel free to email in afterwards. David loves taking questions. You can email in afterwards, and David has a very vibrant blog and podcast, the Freedom Founders blog, the podcast, and also a YouTube channel where he loves to tackle these kinds of questions and provide information and education that's relevant to you.
Let's see. Douglas says, where do you find more information about the Catalyst Group?
Oh, yeah, great question. Douglas, I can send you a link to a webpage with more information about that. I'll do that right now.
You want to just put a link in the chat?
I'll put it right there in the chat. Yes. And then we can email this out afterwards as well. It's freedomfounders.com/catalyst group. Put that in the chat here.
It's a fun group, Doug. You know, if something you want to learn, I enjoy it a lot because we get to have some really great discussions, and everybody's situation is different. And you learn from the other people, their questions, as well as, you know, your own, kind of figuring this out. So if it's something you want to do, you know, be glad to have you. We'll start that. Was it the first week of September?
It'll be the second week of September.
After, far enough after Labor Day. So anyway, yeah, get information on that will be available. But just jump on a call with Alex. He takes most of the calls that people have questions about Freedom Founders or the Catalyst Group, and be glad to, you know, walk you through more about the details. But again, we make it risk free. If it's something you want to do, jump in and give it a try. If it's not for you, no harm, no foul.
And David, I don't know if you remember Alberto from one of the earlier Catalyst groups. He just jumped into the chat here.
Yeah.
Was sharing a little bit about his experience. It's good to have you on tonight, Alberto.
Okay. Well, I guess we'll call it a night tonight. Thanks for everybody for being here, and hope I get to have some conversations with some of you in the near future. But stay in touch. Whatever we can do to help you, we'll be here. All right. Have a good night.